Well, welcome back, everybody, to Black Diamond Mortgage, and it's Fix Your Credit February. And so we're talking about the least desirable thing in all of mortgage, which is credit, because everybody just wants good credit and nobody wants to have to do anything about it. But the reality is most of us have some stuff to do. And so we want to provide the what you need to figure out how to get a loan, especially if you have had a credit issue in your life or something didn't go perfectly. So this topic really is can be absolutely directed to somebody who has some credit challenges and wants to know what to do. But I'm mostly talking to real estate professionals who are going to be working with somebody who might run into a challenge related to credit. And then it gets down to kind of two or three scenarios. Are we not doing anything right now because of the credit? Or are we close and going to fix things? Or are we going to start working on our credit? There's options, but when credit issues come up, sometimes they derail a transaction. There are solutions that can keep you moving in the current environment while your credit's not perfect. We're going to talk about some of that today. Next week, we are going to talk about getting your credit fixed because you've already deemed it to be needing fixing. So we have an app at Black Diamond Mortgage. It's a mortgage readiness app, and in it is a bunch of credit repair tools. So next week, I'm going to introduce that. So if you get through this week and you're like, wow, I don't think I can buy a house right now because of my credit, that just means you temporarily cannot buy a house because of your credit. And now you need to start working on it and you can get the app. So that's next week. But this week, we're going to dive in a little bit to what do you do if your credit's not perfect, but you want to buy the house right now? Now, Maria last week talked about some government programs that help people with credit challenges by design. And those are probably the best ways to buy a house if you can fit into those programs. So, what I wanted to do first was talk about what if you just don't quite fit into that, but maybe you could. That would actually be better than going for the alternative options, which we'll touch on the second half. So, I'm going to go over some scenarios where you might be just outside and somebody trying a little bit harder than your typical lender might be able to get you back in the boundaries of these government programs that are the best for having some credit challenges. As we talk about any of the stuff that we're talking about today, if you're a real estate professional, you have to do this one thing, otherwise it's not worth it. You have to, we'll say two things. One, you have to eliminate hopium from your toolbox of things. Hopium, something Zach talked about to our team the other day. But hopium's where you believe something really optimistic to happen when it's not really very realistic, and you act as though everything's going to be just fine, even though it probably isn't. If you have a credit challenge involving a loan and it's getting the loan to go into the decline state, the reality is the solution's probably going to require quite a bit of effort and things like getting a little more time on the contract are reasonable requests. So if you're a real estate professional, you're working with somebody who's got a credit problem, you find that out in the middle of the transaction and you want them to get a house because you are their advocate, you need to probably plan on getting them enough time to fix the problem and stay under contract. A lot of times we get a lot of blowback from real estate professionals who don't think that there's any reason that that should be necessary. But if you're going to go for the closing and not the denial or the canceled contract, then you got to get a little more time. So as we talk about all the stuff that we're about to talk about, if you are a real estate professional and you do have a scenario where you're going to do these things, they're going to take a little longer than your typical 30-day close, but maybe they only take 45 days or, and if you can get everybody together, you can get a closing, and that's probably worth it. And that's why we're taking the time to talk about it. So, I always like to talk about on all mortgage stuff, how mortgage decisions are made. So I'm going to draw my 3 C's triangle. And if you've been to any of my classes, you may have already seen this, but I'm just going to write it out here real quick because everything revolves cash flow, credit, and collateral. I'm probably spelling collateral wrong because I have no confidence I've spelled it right here. So it's whatever I meant to write. And credit score. And I'm going to show this to you. Hang on. Okay, so this is what we call the loan decision triangle. And you've got your income cash flow, you got the collateral, and then you see you got credit score. Today we're talking about credit score, that little department down there. The reason I show it to you is all three of these things are necessary to get a mortgage. And when you're weak in one, you're going to have to compensate in the other. So when we talk about solutions, if you're having trouble here, then something's got to give on these other departments. Now, there is an exception, which is why I wanted to start with this. I'm going to write it in the middle. The government. So the government has created ways to help people that allow them to be deficient in areas and not remedy it very much. So when Maria was talking last week, it's like your FHA loan, your VA loan, and even the Fannie Mae and Freddie Mac loans have some grace built into them that are designed to make it a little easier to buy a house so that the bank isn't just evaluating the three C's. The bank's like, well, I'm evaluating the three C's, but I'm going to get some support from one of these government agencies. And as long as I make their standard, then maybe I don't need as much down payment, or maybe I don't need the credit score to be quite as good, those kind of things. So when you're thinking about solutions to loans, those three always come into play. And if they don't 100% come into play, it's because the government's helping. Because if the bank had to just loan their own money out, they would have to make a really conscious decision. If your credit's bad, then the income's got to be way higher or the down payment's got to be way higher. If you don't have to make up down payment and income, it's because the government's involved. And so the government involved is the products that Maria talked about last week. And I wanted to talk about, you just got a denial on one of these government products, but you thought you were going to get one. What if you could get back in rather than go to the other options? That's the first thing you should do. So we're going to talk about some things you can do that are it's all in the weeds. So obviously, if you're ever in one of these situations, you're like, I'll just call Dave. But knowing a little bit about it kind of helps you prepare. So one of the things is when these loans are underwritten, they take the loan application and they take the credit report, and it's all digital, and they marry it together and they run it through this thing called an automated underwriting system, or an AUS. And if the automated underwriting system says the loan is declined and you don't do any further work, then the loan is declined. And that's the end of the story. But what if you got into the details and made sure, because it's some people refer to junk in, junk out. But if the information isn't 100% accurate, then the decline may not be accurate. So what if there's ways to double check all the information and make sure that you can't get that automated decline into an approval? So some easy things that you can do. If your borrower or your client has a bankruptcy or a foreclosure or a judgment that's digitally represented on the credit report, their situation might change if you validate the bankruptcy discharge date. If the credit report says it's on a certain date, then the computer just counts off a couple of years and then they say, as of this date, you can get the loan. Well, if you can validate manually that the date is actually more recent or later and it swings the approval, the underwriter for the lender is allowed to go into the computer and update that date. And now you just got an approval that was a denial. And it happens a lot on foreclosure and bankruptcy because you go through this process bankruptcy called discharge, and then the district judge files a document, and there could be a month or two variation from when that occurred and when the credit report says that it occurred, and the automated underwriting is just going to get it from the credit report. It's even worse on foreclosure. I know in the '08 housing crisis, there's some states in the United States that do what's called a judicial foreclosure, and then there's others that do more like what we do in Montana, where the borrower effectively signs this document when they take out a mortgage called a deed of trust. And when they don't make their payments, basically the foreclosure just happens automatically by the lender going and just saying, yep, we haven't had payments. I get the house. In other states, they have to go through a judicial proceeding. And these proceedings can take a long time. And then down the road, so you may have somebody whose dates of foreclosure are off by years and not even months. So their ability to go out and get another home might be just when some paperwork got filed in comparison to when the actual judge swung the gavel and said, I shall take this person's house away. So if you have a borrower that has a historical bad credit item and the credit report says one thing, it's possible that the actual dates are different. And by simply getting those dates validated, you can get an approval that was a denial. Other things that are on, you should, once you get a denial, you should just look over your credit report and see if there's anything inaccurate on it beyond what we just talked about. If the digital information can be updated, it could swing it to an approval. Then there's some little massaging you can do. Some loan programs allow a little bit of disputes, not a lot, but a little bit. If there's no disputes and you can stick a small one on there, you might be able to bump the credit score up just a notch and swing it. Now, this would take 15, 20 days to get all this to happen. So if you're pressing up against a closing date, not that great. But what if everybody wants to make this happen and another 15 days makes a difference? You can't have too many disputes, but you can have a little bit. So you can check the guidelines and see, and then run the credit again, and you might get a small improvement. There's lenders that will do manual underwriting. Maria probably talked about this a little bit last week, but the automated underwriting might say refer ineligible or something like that. And it might say refer eligible. And what it's saying is it's not a very good situation. I don't recommend doing the loan. Most banks are going to go hit the decline button right there. But lenders are allowed to go into the loan application and manually check things out. And if they think it's something that's not horrible to the overall loan picture, they can override that. And that's called a manual underwrite. So if you do that, you get back into a government-backed loan and you don't have to go for the other options. Here's a little tweak that a lot of people don't know, but child support is often a negative on the cost to the borrower or alimony. There are some loan programs that allow you to switch it to an adjustment to the income instead of a liability. And it actually improves their look because it's when you do the math, it doesn't look as bad if you reduce the income by the amount of this than if you call it a debt that you have to pay. And so somebody that has a big child support or a big alimony, there's nuanced guidelines that allow you to switch it from an adjustment to the income from an adjustment to the credit. So here you have a decline. If the loan officer or the underwriter is not going to try hard for the borrower, it could be as simple as just fixing that. Other things are you've been through you kind of looked everything over, looks pretty good, but there's something that's just really bad about the loan. It's got a foreclosure or bankruptcy or something like that. And it's just going to be a little while before they can get approval, unless there's an extenuating circumstance. So most of the loan programs allow for approvals to be granted when there's an extenuating circumstance. So you would have to do that by presenting the extenuating circumstance. The ones that we've seen successful at our office is medical catastrophes, are the waiting periods that are normally required for bad credit can be waived if you can demonstrate an extenuating circumstance. Other example could be like you own your own business and you just get wiped out like Trump style in New York, where he just got hit with a $350 million lawsuit in the state of New York. Brutal. Like you got to come up with $350 million. But what if you pick up a job right after that? Like now I'm the president of the United States and I get a paycheck. Maybe you don't have to wait the normal waiting period because you can meet the definition of an extenuating circumstance. And basically, what it is something really horrible happened. It's going to take you out financially. It's stopped, so it's not happening anymore. And then the problem's been addressed. It's not likely to continue. And it wasn't totally like your fault as far as looking forward into the future. So an example would be like if you had cancer and you got a whole bunch of medical bills and you lived through it and you had to file bankruptcy. Normally on some of the government loans, you wait like 2 years to get eligible for a loan again. Well, it's written right in there that if you can demonstrate that it was something like that and you can isolate it, then they can actually waive that waiting period. So we've seen it with medical. You can do it with crazy job situations. Sometimes you can do it with a divorce, which would be like you're the of the two people in a marriage relationship. The divorce caused you to be unable to pay your bills, and then you've now reestablished things. You might not have to wait the amount of time that would normally be required for like bankruptcies and things like that. So extenuating circumstances are a great way to avoid a decline when you get one. So let's say you've done all that and you still can't get a loan, but you have some redeeming factors. Then there are some loans in the marketplace. And so I wanted to talk about a few of those. But I do recommend that the first thing you do when you have a situation is go through everything and see if there's a fix and you can get back into a normal product. So let's say I would say the easiest one to do, and this is not something you might think of, but if you're over 62, get a reverse mortgage. And the reason is they don't care about your credit. So a reverse mortgage is a collateral loan only. So in the big triangle I showed you, you just have to be old enough to get one. So if you're needing money and you're over 62 and your credit's not that good, you actually just switch products from a forward mortgage to a reverse mortgage, and you'll be approved as long as there's enough equity and cash involved in the home. Now, another thing you might just want to check before you proceed with other options is do all the borrowers need to be on the loan? If a bad credit borrower is on the loan and then there happens to be one with better credit, there might be an easier solution by just removing the worst credit borrower. And if you've done all that, then there's some banks that have actually stepped into the arena and they're looking for good loans. So now we're back to this. We're back here, but we're going to take these guys out. There's no government support. So what would be a scenario? You got a credit problem. You got a foreclosure. It's legit. The normal waiting period on a Fannie Mae Freddie Mac loan is 4 years. But other than that, it's a pretty good looking borrower. So they got a good job. They have a down payment. Well, there are lenders out there that actually specialize in making that concession. They're basically non-QM lenders. So if you've heard of a bank statement loan or you've heard of other loan products that are not underwritten traditionally, they also have credit variances they allow. So I actually have a rate sheet right here from a lender that we do business with. They have a product that if you have 30% down, so we are swinging the needle here. We're going to put a heavy emphasis on collateral. We got a big credit problem, have enough income to qualify. So if you can get enough down payment, they'll have no waiting period on the foreclosure or bankruptcy. So as long as it's happened and you have a down payment, you're able to get the loan. So say you're a realtor on a situation, and one of these credit items comes up. The guy thought it was been a year. He thought it had been 3 years, but it's only been 1.5 or something. But they find out that, and they're under contract and we want to close. You get a decline from the lender. You can accept that and go, well, yeah, you had a foreclosure. I guess I'm not going to be able, or you can ask questions, because if they can come up with a little bit more money down, they can actually buy a home with a non-QM loan. So good to think about that. There's also like little variances on the lates so when you're in the credit report and you're in the weeds, there are things that are unacceptable to Fannie Mae, Freddie Mac, FHA, and VA. But if you have a down payment, you might be able to get a non-QM loan where they'll cut a little grace. Like one thing they typically won't do, and this is when I was at the beginning, I was talking about hopium. Hopium's really bad with poor credit borrowers. So the scenario is they have really bad credit and they don't like to pay their bills ever, and they want a loan. And then you call Dave and you're like, hey, I hear you can do these cool loans. Well, one of the things the lender is going to look at is why should I give this guy a loan or this gal a loan? So they're going to be looking at, if they have bad credit, is there a reason why the loan's not going to end up, not getting paid? They're going to have to see something. So they do like big down payment. Why do they like big down payment? Because if somebody puts a whole bunch of their own money on the table, even if they've had bad credit in the past, they probably don't want to part with the money. So they might pay their mortgage. So they'll cut them a little slack there. Or the problem's been fixed, or the problem isn't egregious. So sometimes one of the things they'll look at is the recency. And so typically when you are getting approvals on these loans, what they're not okay with is if you pull the credit report, and this is the month of February 2024, and if the credit report is littered with late payments in January of 2024, they're like, I don't think so. But if they have like a low credit score, maybe some credit trauma, but it's like all from 2022, and they've since been doing a pretty good job, but maybe they're not getting the approval with the regular government backed loans, they would be like, well, if it's been 12 months, they've been doing everything right. And then we can analyze their income and their income's good and have a reasonable down payment. We could probably give these guys a loan. And so that's the space that they want to operate in. One other department that's kind of interesting, I think it'll become more popular. So I thought I'd just mention it in this particular class, is there's loans for foreign nationals that don't have credit because they don't live in the United States. And so really the thing that they need to get a loan is similar to the bad credit borrowers, just a down payment. So if you're having people that are like unable to get a loan because they don't have a registered credit score and they're foreign national, but they got a good job and they want to buy in the United States. I mean, seems like a lot of people are coming to the United States lately. So with income and a desire to buy a home, like that's still a potential buyer. And if they're not able to get a loan through one of the agencies, which could be due to the fact that they don't have a credit score, they can look at these non-QM lenders. That those are the kinds of loans that they want to make. There's actually some people out there that are foreign nationals that make really good money and they just don't have citizenship or something like that. So those are the big takeaways for borrowers that want to get loans that have a little bit of credit stuff, or they just don't fit in the box perfectly. Got a few people in the room here and a few online. Wanted to see if anybody had a question. I got one right next to me. Go ahead.
Can you describe gifts and how they can actually help with the gap of the collateral?
So the question was, what about gifts? So I would just say they're a gift when it comes to this problem. Most lenders are happy to consider a gift as the solution to the down payment problem. So if you're in a scenario and the problem comes up that credit's not great, the borrower needs more down payment, they don't have it, A gift can solve it. Now, I will say there's an exception. A lot of lenders won't do that on an investment property or like a second home because they really look at the borrower's ability to come up with that down payment as part of their loan strength. But on a primary occupant borrower, the perception is that the homeowner is going to want to value that gift that was given to them, and they'll treat that like their own money. So that's typically where borrowers that weren't planning on coming up with money come up with it. Mom and dad, grandma, grandpa. So if you're a realtor and you have a loan that's got a problem, one of the first things you should say if you're trying to hold a deal together is, do you have a parent or a grandma or grandpa wants to help out? Because a lot of times that is where the solution comes from. So great question. Hey, Stephanie. I got one more. Go ahead.
What if I have a judgment on my credit? My score is still acceptable. What happens if I want to go to close and my income's good, my collateral's good, my credit's good, but that judgment's hanging out?
So the question is, I have a judgment and we can see it on like the credit report. Sometimes they're on the title commitment. So they can be sneaky. The worst thing about a judgment is sometimes it's not on the credit report and we're getting close to closing and the title commitment comes out and bink, there's a judgment of $50,000 on there. And guess what? It doesn't go anywhere unless we fix it. So as a general rule, judgments need to be satisfied. However, on the more positive side, as a general rule, judgments are not looked at the same as all the other credit. So other credits like, oh, you have this bad record about yourself. You need to like clean up your record. Maybe you need to let some time go by. Judgments are just like a bill that needs to be paid. And so what we typically see with judgments is somebody needs to bring the money to the table, and it's as simple as that. So if you think about it, if I'm on the other side of a judgment and somebody wronged me and I'm entitled to get 50,000 someday and they never pay, and I'm like, dang it. Well, what typically happens, the way these people typically get paid is they go to try to buy a house someday. And then they're like, you can't close unless you pay. And so that's kind of when the cleansing occurs in the legal system. A lot of times when people have a judgment against them, they just go, well, I can't pay right now. So the judge is like, well, we will just attach this to your social security number, and anybody who ever checks is going to see it. And most lenders are like, you need to fix that. One cool little detail is on a VA loan, you can have up to 4% of the sales price go to closing costs or judgments. So if you have a borrower that has a known judgment and they're a veteran, they can actually have the sales price pay off their judgment at closing, which is a very cool tactic. So, well, I'm going to wrap it up with that. I think the biggest thing I would say is, if you paid attention to what we were talking about today, is if you get a decline, first thing to do is get in the details and make sure everything about that loan application and credit report is correct. Sometimes the solution is just fixing something that's incorrect, and it takes a little effort because it's in that database. That's the best way. The other is generally speaking, seek an alternative product, maybe come up with a little more down payment, close, and then go after the regular loan in a couple of years when you get there. And then if your credit's just tough and you're like, I want to buy a house, my credit's tough, it doesn't look like it's going to work right now, still work on it. What you do is what we're going to do next week. We are going to unveil again our mortgage readiness app, and it will actually show you how to get your credit score up so that you're not in the wilderness trying to figure out, how am I ever going to get my credit fixed. That's next week. So great to see everybody.